Now, I have this visual right here that I'm also including, and you can share it with your clients, that explains all the different types of penalties. The first section right here is going to be about the underpayment and estimated tax penalties, where it explains that the tax system is a pay-as-you-go system. So we have to let clients know that with estimated taxes that you can't just pay the balance due at the very end of the year. The IRS wants you to pay these balances throughout the year, not at the end of the year. So if you do have a high balance, or if the client does have a high balance, especially as a sole proprietorship, and then never paid prepayment throughout the year, they're going to face a penalty at the end of the year, and they're going to be surprised of why they're paying this penalty, especially if they made the payment before April 15th. So we have to explain to clients that IRS is a pay-as-you-go system. That's the best word to use. That's the best phrase to use, is that as a pay-as-you-go system, you have to pay it quarterly to the IRS. And with this visual, not only does it explain what the penalty is, but also ways to avoid the penalty. With the first way, depending on what your income is using last year's tax liability numbers. So if the income is under $150,000, what you could do is take last year's tax liability, divide that by 4, and that's what is expected to pay every single quarter, and that's how you avoid a underpayment penalty, by using last year's number. Even if this year's number, where the profit just skyrocketed super high, well, they could still pay last year's number in 4 equal installments and still have a balance due at the end of the year when they filed a tax return. But as long as they made stat prepayments according to the last year's number, then they could avoid a penalty. Now, the other thing is that if their income is over $150,000 and we're using last year's numbers, then they have to pay 110% of last year's tax liability. So takes last year's tax liability, times that by 110%, just pretty much add 10% on top of that, divide that by 4, and that's what the amount you should be paying, or the client should be paying every single quarter. Even if their profit is sky high this year as opposed to last year, as long as they make those 4 quarterly payments according to last year's tax liability, then they could avoid a penalty, and then they'll just pay the remaining balance at the time of tax filing. Now, the second thing, or the second way to avoid a penalty, which is just pay 90% of the current year's tax liability. So by doing some tax planning, we kind of know exactly where the client stands. So every quarter we'll just say, okay, it looks like your profit is $100,000. The tax on that is, let's just say $40,000. Just pay 90% of that $40,000 for now. And then we do another planning the second quarter, third quarter, and fourth quarter. And that's usually the way to use the second alternative, is paying 90% of the current year's tax liability. Now, from my experience, I think it's easier to use number 1, trying to figure out what is either 100% or 110% of last year's liability, just because it's consistent. We know ahead of time what we need to do. So if the client doesn't do tax planning, they could just go through number 1 and try to figure out what last year's tax liability was, divide that by 4, and use that as a prepayment schedule. Now, I want to give you this one advice when it comes to these underpayment or estimated tax penalties, that sometimes it's actually okay for the client to pay these penalties. Now, for this year in 2024, the penalty rate is around 7 to 8%, so it's fairly high. So this probably wouldn't apply for this year. But back then, when the interest rate was really low and the penalty was only around 3%, a lot of my clients were inclined to not pay the estimated tax penalties, and they're okay with paying this 3% penalty because they knew that if they took that money and reinvested it into something else where it earned up maybe 7%, 8%, well, they're gonna be ahead, because instead of the money going to the IRS, it's gonna go to another investment, earns 8%, and then the IRS is just going to charge them 3% penalty for whatever that balance is. So they come out ahead because they're earning 8% here and paying 3% penalty here, right? So sometimes it is okay to have the client pay this penalty if it's low enough, or if they know that if they have another investment that will return a higher amount compared to the amount of the penalty that the IRS is imposing. So that's one tip. So I do tell clients that back then when the interest rate was low, is that, hey, it's not actually a bad thing to pay this penalty because it's only 3%. And if you know you're going to get earnings of 5%, 6% somewhere else, it might be better to skip making the prepayments and just put that money into that investment.